Despite the negative GDP forecast by the World Bank, the market managed to close on a bullish note as it closed north of 35,000 points, an increase of 261 points day over day, up by 1100 points month to date, thus reducing year-to-date decline to 13.9%. Sentiments have managed to remain positive for 4 consecutive days following pre-budget rallies. On a day-on-day basis, the financial sector stole the show as they remain major market movers. UBL rose by 4.9% day-on-day, HBL up by 4.1%, Bank Alphala and MCB up by 2.2 and 1.7% respectively. The banking sector stocks are currently at attractive valuations and have yet to contribute to the overall growth in the 100 index. MCB in particular remains well placed to ride out the yield curve. The big four banks in particular are at attractive valuations with huge potential for capital gains as well as dividend income streams. A look at the recent trends would show us that after touching a high of 41,600 points by the end of Jan, owing to the widespread of the pandemic, the market declined by around 12,400 points. This would have been a great time to build up your portfolio and reduce your average cost, after which the market took a breather and gained 4,800 points to close at 34,112. The market largely remained range bound from 1st till 4th June, and from 5th June onwards, sentiments remained positive owing to pre-budget rallies, and the market rose by 231, 399, 54, and 261 points for 4 consecutive days, leading to 946 points cumulative gain in total. The market had fallen by 28% during Jan and March and has managed to gain 20% to date. Additionally, on a year-to-date basis, foreigners have managed to record net outflows worth USD 267.6 million versus net inflows of USD 54.8 million in the corresponding period of the previous year. With respect to COVID-19, number of confirmed cases in Pakistan are south of 114,000, up by around 5,300 in the past 24 hours, increase of 19,000 cases since June 6th. Looking ahead, market expects a jump in cases owing to the lifting of lockdown and secondly the upcoming Eid celebrations. On a similar note, the World Health Organization is in talks with Pakistan regarding the implementation of intermittent lockdown to counter a surge in the coronavirus infections that have resulted from the recent lifting or reduction in social mobility restrictions. Looking ahead, key drivers of the market would be the widespread of COVID-19 cases, coupled with the budget announcement on the 12th of June, where managing IMF mandates, constraining deficits, and controlling negative externalities of the ongoing COVID-19 pandemic would be the pillars on which the budget policy would be formed. With regards to the FX market, the rupee closed at 164.6 versus the dollar, remaining flat on a day-on-day basis, depreciating by 90 basis points month to date, and a decline of 6.3% on a year-to-date basis. FX reserves for the month of May came in at 16.9 US billion, down by 1.8 billion month on month, a decline of 1 billion on a year-to-date basis. FX reserves for the month of March closed at 17.1 billion, marking an outflow of 1.8 billion on a month-on-month basis. This was largely due to widespread of the pandemic, which induced heavy foreign selling as hot money poured out of the country, where foreigners sold a major chunk of their T-bill holdings and a minor chunk from their PIBs and equity holdings. And this was also the same time around which the rupee hit a high of 167 against the dollar. In the subsequent month of April, the depleting reserves were shored up by temporary deposits from friendly countries like Saudi Arabia and China, as April marked an inflow of USD 1.6 billion, taking April's reserves position to USD 18.7 billion. After which, in May, reserves came in at 16.9 billion with an outflow of 1.8 billion. Still waiting for an official statement on the reasons or the buildup of the 1.8 billion. However, sources say that a large chunk of the outflow pertains to debt repayments, which are expected to be parked in the coming month. A look at the 10-year US Treasury yields. With regards to the 10-year US Treasury rates, the benchmark rate started the year at 1.92, and after pricing in the emergency rate cuts by the FED to spur economic growth, closed at zero point 0.7 at March end and managed to close at 0.84 on 9th June 2020. Many institutions having a USD denominated fixed income portfolio may have recorded sharp increase in their mark-to-market surplus, as your benchmark rates and the mark-to-markets are inversely proportional. However, there is enough evidence to suggest that this is only true for investment graded bonds. Bonds that are non-investment graded tend to have a higher risk premium attached to them, and instead of recording a surplus may have recorded a deficit. Non-investment graded bonds are those that are below BBB minus. They're called non-investment grade or speculative or junk or high yielding bonds. And investors normally demand a higher risk premium on these bonds. So instead of recording surpluses in a decreasing interest rate environment, these non-investment grade or speculative bonds may end up recording mark-to-market losses even in a declining interest rate environment. To keep up to date with latest developments, be sure to subscribe and hit the bell icon. Thank you for your time.